Morning if you've just joined us. We're still letting people into the meeting, so bear with us whilst we let everyone who wants to get into the session. Just a reminder, if you've just joined us, this is the AFM tax and regulatory update. If you're in the office and forgot to move the clocks forward yesterday, this is not your 10 a.m. well-being session, it's tax and regulation. For many people, that has the same kind of cathartic, relaxing advantages that a well-being session would do, but it's definitely tax and regulation. We'll be starting in around 30 seconds. We're just waiting for a few more people to find their way into the session. So let's kick off. Thank you again for joining us today. Tax and regulation on the agenda this morning, and we're very pleased to have BDO as our hosts and presenters today, and they're going to take us through a whole range of different issues, which I'm sure you will find very topical. There will be plenty of chance to ask questions later on, and of course we'll also share a copy of the slides and a recording of the session later on if you need to review anything that's covered. I have a couple of questions for our presenters to kick things off. First of all, on tax, I'm looking for a better understanding of what the budget last week means for businesses and how that might affect mutuals in the next couple of years. And from a regulatory perspective, and just importantly, I'm particularly keen to understand whether the recent problems that the FCA has with staffing mean that it will be announcing in the near future that it will be offloading all of its current employees and replacing them with agency staff with no financial services experience. So those are my two questions. I'm sure you can do better than that. So if you have a question, please use the question facility at the bottom of the page. But for now, I'd like to introduce Thomas from BDO, who's going to be doing the bulk of the hosting for today. Good morning, Thomas.
Thank you, Martin. Good morning to you and good morning to everybody who's joined us. I'm Thomas Toe. I'm an insurance tax partner at BDO. We have a really packed agenda today, as you'll see in the next slide. And we'll be covering a lot, including the spring statement from last week. There wasn't a huge amount of spring statement last week for tax. I think a big talking point was perhaps what wasn't included in that spring statement. But anyway, we are absolutely delighted to be able to collaborate with AFM to bring you this tax and regulatory update, and look forward to hearing your questions and hearing your thoughts as well. So I'll let Michael Whiteside, my colleague, to kick things off with corporate tax.
Thank you, Thomas. So yes, so just a brief introduction on me. I'm Michael Whiteside. I'm a senior manager here at BDO. I've been at BDO for 2.5 years. I joined September 2019. I have been working in insurance tax for over 17.5 years now, and I have a range of experience across the insurance industry, with a focus on life assurance and life assurance mutuals. I'm going to spend about 15 to 20 minutes talking about corporation tax generally, plus a little bit on the spring statement, as Thomas mentioned. If you have any questions, let us know. Otherwise, you can ask them towards the end. Next slide, please. So, latest corporation tax points of interest and the spring statement. So, I'm sure many of you will know or be aware of the headline rate of corporation tax for proprietary companies. It will increase 25% from April 2023 for those larger companies. Smaller companies pay at 19%. I would note, obviously, a lot of the audience is life mutuals and may not be subject to tax on their sort of insurance business, at called mainstream corporation tax. But to the extent you have parts of your business or other entities that are subject to that corporation tax rate, this will be of interest to you. On that note, the 25% rate to apply for April 2023 is already in law. It was substantively enacted halfway through last year, which means that as at balance sheet dates, if there are any items unwinding after April 2023, the 25% rate should be applied to that deferred tax item. And finally, on corporation tax, just generally, making tax digital is on its way, expected to come in around about 2026. I'll talk about that a bit more on the back of a consultation that HMRC issued and was responded to during the last year. The investment super deduction, so this was heavily trailed by the government as a major tax incentive for businesses to invest in capital expenditure. Groups, including life groups, can benefit from this. So you can get 130% deduction on main pools additions for qualifying fixed assets. So to the extent life groups have got qualifying fixed assets, they can get a super deduction. Main pool additions, including things like computers, office equipment, that sort of stuff. Plus, there is also a generous 50% upfront deduction for special rate pool additions, which includes integral features, things like lifts, air conditioning systems, that sort of stuff. And finally, the annual investment allowance, which is a 100% upfront first year addition, can be applied. Obviously, if you have items that qualify for the 130%, you probably take that in preference, but to the extent you don't, the AIA will allow you to get a deduction for 100% first upfront. I would say both of these apply until the end of March 2023. I don't think that's a coincidence, to the fact that the corporation tax rate will go up to 25% at that point in time. So the intention of the super deduction is to make sure that people don't defer all their capital spend until the rate goes up, because they can still get generous relief right now. Finally, on NOS relief, there has been an extension to this. So historically, for corporation tax purposes, you had trading losses back 1 year, unlimited trade carry back for 1 year, and that's been extended now to 3 years. The 1 year is still unlimited, but there is a 2 million cap for the 2 previous year carrybacks. Note that this just applies to trading losses. So any excess management expenses on I-E business, for example, will not be able to be carried back 3 years, indeed not even 1 year, because historically they've never been able to carry back those excess management expenses anyway. I'm just going to switch to the right-hand side of the slide. I'll talk about spring statement shortly, but I did want to mention on the right-hand side the repeal of Section 79 FA 2012. So this is an area of particular interest for life assurers, and including life mutuals, life friendlies, because it impacts the I-E calculation. So historically, for a long period of time, Blaegab acquisition expenses the relief for them was spread over 7 years. The intention of the revenue is to repeal this and allow relief for the Blaegab deferred acquisition expenses in line with the accounts. So the spreading of those acquisition expenses themselves in the accounts, the tax will then align to that. This brings it in line with most other items that are subject to external audit. And is hopefully a simplification to determine, sort of how those acquisition spread expenses will arise. The interactional transition will need to be considered, and we are expecting regulations to outline how the rules will work at some point shortly. Like I say, so the spread of Blaegab business can have different terms, so the spreading will be different for different companies rather than the fixed 7-year that existed previously. And finally, on mutuality, obviously this is a particular interest to a lot of people on the call. We are aware of HMRC asking questions about mutuality, particularly about company structures and legal ownership recently. Just by way of background, HMRC's view of mutual trading is in the Business Income Manual 24020 and is outlined there. I won't read it out, but you can see that in the guidance, and obviously we will send these slides around, as Martin mentioned, so you can have a look at them. And finally, so you'll be aware of the Health and Social Care Levy, additional 1.25% for April 2023. I think, as Thomas said, one of the interesting things was what was not in the spring statement. One of the things not in the spring statement was the removal of that Health and Social Care Levy coming in. Martin also asked about the 2022 spring statement announcements and how it might affect your business. From a life tax perspective, the most interesting thing for me was that first bullet. So the reduction in personal income tax basic rate from 20% to 19% in 2024. Now, the rules for the policyholder tax rate on the policyholder share of I-E profits. So for mutuals, that would normally be the full I-E profit. Applies the basic rate of income tax, so that we would expect that to fall to 19% from 2024. So that's a big change. Not necessarily in terms of quantum, but in terms of how the policyholder tax rate applies, and also for any internal systems that need to take into account the change in the policyholder tax rate as well moving forward from that date. A couple of things that might be of interest from a personal point of view, and I won't dwell on these, but an increase in the NICS threshold, a 5% cut in fuel duty, which has already taken effect, and an increase in the employment allowance. The only other thing I was going to mention is the one in the middle. There was, in the spring statement, a comment on R&D tax credits and capital investment spend that's going to be considered during 2022 to potentially give rise to changes in April 2023. Next slide, please. So a little bit about recent consultations. One of the things of great interest to insurance groups at the moment is the adoption of IFRS 17. I appreciate a lot of people on the call will have their accounts under UK GAAP, IFRS 102. And also, as mutual groups, their trade profits on their insurance business, if you like, are not subject to tax on the mutual principle. So I won't dwell on this too long, but it is of interest to insurance groups generally. IFRS 17 applies from 1 January 2023, and one of the particular things of interest is the application of the transitional adjustment on a restatement of the opening balance sheet, and whether for tax purposes that will be spread. Obviously, like I say, the main impact will be for those proprietary companies under IFRS, where they will either be spreading or bringing into account the transition adjustment, and we don't actually know the specific rules yet. That will come later or during 2022. As a firm, BDO have submitted a response to the IFRS 17 consultation, which can be found on our website, and some of the points of interest are listed out here. For example, our expectation that the mutuality principle will remain and won't be affected by the fact that some companies might move to IFRS 17, and the interaction with Making Tax Digital, and consulting with companies who are moving to IFRS 17, how they may adopt that in relation to Making Tax Digital moving forward, which I'll come to shortly. Just to say, finally, draft legislation, like I say, is expected in summer 2023. IFRS 17 applies from 1 January 2023. Draft legislation expected in summer 2022. IFRS 17 comes in January 2023. So obviously it's of great interest, and we will see what the legislation says when it comes out shortly. And then Making Tax Digital for corporation tax. This is in line with the government's approach to making all sorts of taxes digital. I think the key things of interest are that all entities within the scope for corporation tax will fall into the regime for making tax digital. That will include life companies, life mutuals, friendly societies. I would expect all of them to fall into the regime when it comes into place. As I said on my first slide, though, it's not likely to come into place until at least 2026, but is worth considering or bearing in mind that it's on the horizon. It will mean there'll be more record keeping and, importantly, more regular reporting. So we're expecting the revenue to require quarterly updates in relation to the results that companies are generating. And that's part of the Making Tax Digital process. And finally, it's just worth noting that quarterly submissions aren't just going to be about reporting profits, expenditure and income. It's also a chance to provide a business update on structure or any changes in the business. So things will be done generally on a more real-time basis, which aligns with one of the points on my next slide about administration of large businesses for corporation tax.
I mean, just to add on the MTD, I mean, we did as a firm in our response to the consultation suggest that groups in life business, Lloyd's of London, for example, have specific tax regimes are accepted from this Making Tax Digital, but unfortunately HMRC were having none of it and saying that everybody will be subject to MTD. However, they will take into account comments from the industry in terms of how to implement that regime as best as possible for all taxpayers.
Yeah, thank you. Next slide, please. A couple of other things, or relatively recent things of interest. So notification on certain tax treatments. This is specifically where there is sort of a treatment for tax purposes, and it's corporation tax, VAT, or income tax. But for example, a treatment in corporation tax that is not clear. So it could be a position that's taken in their filing returns that the revenue may not necessarily agree with, and it applies to large businesses, and there are two triggers. One is where there's a provision in the accounts, a provision put through the tax line reflecting a different tax treatment. So that's to cover the potential additional risk that might arise from being successfully challenged by the revenue. Or it relies on an application of law which is not necessarily in accordance with HMRC's view. I would note this is for large businesses and where the tax advantage exceeds 5 million. Those are important thresholds, which means a lot of uncertain tax treatments will not be in point, but it's worth bearing in mind as it applies for returns filed on or after the 1st of April 2022. And I briefly mentioned improving tax administration for large businesses. There was a process launched in the spring 2021 budget, and the revenue has now announced certain points of interest moving forwards around providing more technical guidance, things about the way that long-running tax disputes inquiries, and they specifically refer to transfer pricing, for example, how those long-running disputes are managed and how that process is overseen. And just to make it, sort of a more clarity, transparency around the process and how it's dealt with. And finally, this one may be of interest to companies, particularly on the call. Large businesses that don't have a CCM, so a specific customer relationship manager, HMRC. HMRC will continue to offer support through the mid-sized business directorate's consumer engagement and support team. That's what I was going to say on that. So next slide, please. Which is my final slide, and I just wanted to flag this one. So this is of great interest to a lot of businesses in the UK, but also worldwide. I appreciate that it is relevant specifically to multinational enterprises with revenues in excess of 750 million euros. So a number of the groups, or a lot of the groups on the call, probably not be necessarily in point. In addition, so essentially pillar 2 is what I'm talking about here, and it applies a top-up tax where the effective minimum rate of 15% of tax, the amount is lower, so there's a top-up tax to get it to that 15% effective minimum tax rate. And obviously this is the model rules were released by the OECD towards the end of 2021. The European Commission put in its proposal in December 2021 as well. HMRC have released a consultation document to determine how the model rules that the OECD have put in place, and that closes on the 4th of April 2022. So the outcome and the commentary is all still to be determined. Like I say, we know it's going to apply to large groups with an effective minimum rate of tax of 15%. There are carve-outs, for example, in the OECD model rules for policyholder tax and things related to policyholder tax, and policyholder tax deductions from the policyholders that the companies make. But the rules are complex, and it's a sort of watch your space to some extent, and just considering whether or not it may be a point for your business.
Yeah, and there's real concern, really. I mean, certainly the clients that we've been talking to, insurers, are big enough to be caught by this. You know, absolutely all of them are concerned by this. I mean, even if they operate in high tax jurisdictions, so the ones that are greater than 15% tax rate, they're still concerned by the amount of compliance and the complexity. And as Mike was saying, recently released the commentary, and you'll be pleased to know that the commentary plus some illustrative examples came to almost 300 pages. So there's a lot to look forward to, but as I said, it's very difficult to navigate, and it's very complex.
Yep, thank you. And then just very briefly on Pillar 1, which was the other pillar of the OECD project, is about allocating profits around relevant jurisdictions, but is not of so much interest to financial groups expected to be out of scope. That was all I was going to say. The only thing on the slides which I haven't specifically mentioned, so that might be of interest, but to some extent is probably a wider discussion, as it could be quite substantial, is the review of the UK funds regime, which is ongoing, and also the new sort of qualifying asset holding companies. I suspect those are topics for another day when things become clearer, and maybe a bigger topic than we would have time for to do today, but just wanted to flag that is underway as well. That's what I was going to say. So I'm happy to take questions now. I don't know whether that will work, Thomas or Martin, or whether we just leave it entirely to the end. But if you have any questions along the way, please just post them in the chat. We'll pick them up at some point. Thank you. I think I'm going to pass on to Martin next.
Hi, great. Thanks very much, Michael. Excellent. Morning, everyone. My name is Martin Callaghan, and I'm a director in BDO's tax assurance and risk management team. So all the work I do relates to good governance, where there's a tax angle to areas such as business risk review, senior accounting officer, CCO, and so on. There's a lot I could talk to you about, but I believe I have 5 to 8 minutes to give you a bit of a focused discussion around 2 particular areas at the moment. The first of those, what I'll refer to as the corporate criminal offences legislation, and secondly, a bit of a conversation about where responsible tax falls within the ESG agenda. So if we could move on to the next slide, please. So CCO. Now, not all of you may refer to this piece of legislation as CCO. Not everyone does. Some others refer to it as the Anti-Facilitation of Tax Evasion legislation. And I'm sure you'll all be very aware of this piece of legislation. It's Part 3 Criminal Finances Act, and it took effect on the 30th of September 2017. So it's been with us for a while. And what does the legislation say? In a nutshell, what it says is that a business, a corporate, be it a company or partnership, could be held criminally liable if an associated person of the business facilitates tax fraud. And the downside of the legislation is significant. It would lead to a successful prosecution would lead to an unlimited financial penalty, clear reputational and regulatory impact also. The legislation is very, very broadly drawn, because I'm sure a lot of anyone working within a well-run business with good governance would expect to say, well, it's highly unlikely that one of our associated persons would facilitate tax fraud. I guess the point to make is that the legislation is drawn very, very broadly. It applies to all taxes, so it's not about the internal compliance of a business. It applies to all taxes, UK and the non-UK equivalents. And importantly, businesses can be held liable for the actions of third parties. So these associated persons. So who would an associated person be? It's all employees, agents, contractors, but also any third party, including, for example, say brokers. If that third party were to facilitate tax fraud, then the corporate could nonetheless be held liable for that. So how do businesses protect themselves? If we move on to the next slide, please. Well, there is a defence. There's a defence from prosecution in having reasonable prevention procedures. And those reasonable prevention procedures are based around 6 guiding principles, which are shown on the on this slide at the moment. And I'm sure a lot of organisations will have taken these steps. We've now worked with 250, maybe 300 businesses in helping them to put these reasonable prevention procedures in place. It's imperative that all organisations undertake a CCO or AFTE risk assessment, identify where the risks may be. Given the broad definition of associated person, it's incredibly important that a reasonable level of due diligence is carried out on your associated persons. Comms and training, communication and training, it's important that awareness raising training is rolled out throughout the business. So this isn't just for those sat within finance or tax. It's about any person within the organisation who may have the ability to influence a financial transaction. Could be HR, could be procurement, and so on. There needs to be that level of awareness and training. And monitoring and review, within the last couple of weeks, we had a bit of further guidance from HMRC. They expect organisations to be updating their CCO risk assessments on an annual basis. And so the final slide on CCO. Can move on to the next slide. I'll start by saying there haven't been any prosecutions yet. The legislation's been with us for, as I said, for a while. I mean, it's modelled very, very closely on the UK Bribery Act, and it took a number of years for the first prosecution to take place under the Bribery Act. No prosecutions yet under CCO. However, 28 businesses, according to figures issued by HMRC, 28 businesses under either investigation or consideration for investigation. And the part of HMRC that investigates tax fraud, the Fraud Investigation Service, they've sent letters to a number of organisations saying something along the lines of, we're not saying that you're committing tax fraud. However, if there were to be tax fraud within your supply chain, perhaps labour providers to the business and so on, staffing agencies, if there were to be tax fraud within the supply chain, then we could prosecute you for having failed to prevent that facilitation from having taken place. Now, those are the legal risks, but interestingly, I think what we're also seeing is an increase in commercial risk to the business, and that includes time and energies spent in discussing CCO with HMRC. So, for example, we know that under the business risk review regime at the moment, CCO is coming up frequently in conversations with HMRC asking a number of questions of businesses about, well, what have you done to comply with the CCO legislation? But broader than that, we are seeing CCO come up in a number of commercial situations, coming up in transaction due diligence, for example. We've seen it coming up in the run-up to a fairly recent IPO. It's included within the tender process for new suppliers, and we're also seeing banks including CCO within their customer due diligence or their credit risk review process. So CCO having a real impact, and according to the head of CCO at HMRC, firstly, it's not a matter of if there will be a prosecution. It's a matter of when there will be a prosecution under CCO legislation. And broader than that, as I said, CCO is also having the potential to act as a business disruptor. I said particularly on the transaction side of things. So that's the update on CCO. If I now move on to responsible tax and ESG. Now, it wouldn't, it wouldn't be a webinar or seminar, a recent one, if it didn't mention ESG or didn't have ESG on the agenda. Now, typically, when people think about ESG, environmental, social governance, the first thing that comes to mind is, well, this is about things such as climate change, for example, climate change and resilience. So where is the T in ESG? Where is the tax element of ESG? Well, it's actually there within each of the three elements. So it's tax is there within the environmental, and this is a matter of, sticks and carrots. The sticks being behavioural taxes, nudge taxes such as plastic packaging, carbon taxes, and so on, and the carrots being in the form of, for example, green subsidies and incentives, the incentives for using electric vehicles and so on. So it's there within the environmental, it's there within the S of social, largely related to things such as supply chain integrity, the use of the gig economy and so on, linking ESG metrics to executive and other remuneration. And it's certainly there within the G, my area of specialism and expertise. And to put a bit more flesh on the bones of that, if we move on to my final slide, please. So how does responsible tax, and specifically the G element of that, align to ESG? Well, Michael, on a few slides back, referred to the cooperative compliance model. And so fundamentally, the cooperative compliance model assists businesses go a long way to meeting, what might be called their responsible tax obligations. And if I sort of refer specifically to some OECD guidance that was issued a number of years ago, talking about the cooperative compliance model, talking about tax control frameworks, this is all about building a relationship of trust between taxpayers and tax authorities and wider stakeholders. And a lot of what we see from HMRC is built around this cooperative compliance model. So, for example, if you read the OECD guidance and then look at areas such as senior accounting officer, business risk review, obligation to publish a tax strategy, all of those elements are built around the cooperative compliance model. How does that link specifically to ESG and responsible tax? Well, there's a lot of guidance out there. None of it is mandatory at the moment, although I think the direction of travel is for this element of governance to become mandatory and governed. And there's a lot of guidance out there. For example, the World Economic Forum talks about tax as a metric for sustainability. There's a group of multinational businesses called the B Team that talks about responsible tax. And there's something called GRI 207. So GRI, Global Reporting Initiative, this is the leading sustainability reporting obligation globally, and they have issued within the last 2 or 3 years GRI 207 that talks about tax and sustainability. And there were 3 key elements to this. The first, based around businesses having a defined set of tax principles and having strong tax policies and published risk appetites. So a lot of organisations will already have been publishing their tax strategies, but now they're explicitly linking these across to sustainability. Governance and risk management, having strong tax control frameworks in place. So if you have strong tax principles, do you have the right and appropriate governance mechanisms in place in order to support that risk appetite? And then the final element, it's all about transparency. And so this is already there to be seen in areas such as CBCR, country by country reporting, but also importantly, what we're seeing is a move for organisations to be more transparent about their overall contribution to society. So looking at their global footprint, looking at not just the headline numbers, the tax figure that appears in the accounts, but being able to demonstrate more broadly what level of contribution they make to exchequers. So details of their total tax contribution on a global basis. I think I may have run over time slightly. As I said, a whistle stop tour there of 2 of the key areas of focus at the moment in terms of tax governance. And I will stop there, assuming that we'll take any questions at the end. I'll stop there and hand over to Aditi.
Thank you so much, Martin. Just as an introduction, my name is Aditi Hyett. I'm a director in VAT. I specialize in helping clients in the sector of banking, financial services, and more importantly, insurance. I'd like to talk to you today about the key things we're seeing with businesses in life mutuals and friendly societies from a VAT perspective. If we move on to the next line, thank you. So the main thing from a VAT point of view, VAT is very driven by business changes and any wider impact. And what that particularly has meant, particularly in the VAT world, is when businesses, when they have launched new products or reacted differently because of changes because of Brexit or COVID-19, those kind of changes have had a VAT impact. So the kind of things we're working with businesses, and it's worth thinking about it, is identifying what has changed for your business since Brexit and since COVID-19, and what those changes particularly mean from a VAT point of view. As examples, we are working with businesses who have launched new products as a result of the wider changes, and we are working with them to identify whether the VAT liability is taxable or exempt. Sometimes it doesn't have to be a new product, it just has to be the same product and businesses are delivering it in a slightly different way or adding more features and more benefits to it. And it's looking at matters such as whether what's being changed is that taking away from the VAT liability the business has already identified, or the VAT liability remains the same. Hand in hand comes costs, and particularly for businesses as friendly societies and mutuals, we would often expect them to be adverse to VAT on costs. They're not typically able to recover all of their VAT. And what that typically has meant is such businesses tend to have a special method agreed with HMRC to recover VAT. And these special methods give businesses an optimized way to recover VAT on costs. One of the things we find working with businesses is that a lot of them may not have necessarily considered whether these special methods that have been in place, whether they need to be tweaked or whether there is an option to get a better result due to the changes that are happening more on the business and more widely economically, politically, or whether, for businesses that don't even have a method, that is also another starting point, is to think about actually, should we have a special method in place that gives us the optimum result for VAT recovery? Particularly due to COVID-19, HMRC have introduced a process in place where certain applications can be fast-tracked. So it's worth thinking about whether input tax recovery through a special method is the right answer for the business. And if it's been long since the business has looked at the method, this is really a right time to look at it and check if the method is fit for purpose or whether anything needs changing. The other common thing we often find businesses missing is reverse charge. So usually when businesses buy services from overseas, the local UK business needs to tax itself on the services that it has purchased, but that rule doesn't apply all the time. And businesses don't often get this right. So there are instances we've seen where no reverse charge has been applied, or we've seen the other end of the spectrum where reverse charge has been applied on everything, and actually not everything had to be reverse charged. So it's worth looking at your business profile and checking whether you have been following appropriate policies, processes on reverse charge, and whether you are over accounting or under accounting, and particularly because businesses in your sector tend to be VAT adverse. This is one of the quick, easy wins to make sure that the VAT cost is optimized. The other point on my slide is HMRC's policy on establishment. Now, this is really important because over a period of time, and particularly after Brexit, we are seeing HMRC look at how the business operates, what assets, resources does it have outside of the country, and what that particularly means from a VAT point of view. And you'd often find conversations with HMRC where they are looking to understand the overseas footprint, and particularly after COVID and in situations where businesses are now starting to have a global workforce, this is becoming ever so important. The other angle to HMRC's policy is that you don't actually have to have your own assets, resources, employees overseas. Sometimes a third party, a subsidiary, or an agent could create an establishment for you. And many businesses often miss this fact. And we have seen situations, particularly where an overseas subsidiary, for example, or an overseas business is being brought onshore into the UK by virtue of a UK business's activities. So the takeaway point here would be is think about, as a UK business, two things. What do we have overseas, and is that enough to create an establishment for VAT purposes? And there will be other tax angles to this as well. The second angle is to think about is, as we are in the UK, are we creating an establishment unknowingly for someone else? And it's looking at the relationship you have not only with your own group companies, but third parties to check actually, is that creating a VAT impact and what that particularly means. The another point, which is not on the slide, but we've seen quite a lot these days, is there was a recent case called Hotel Latua, which looked at situations where businesses could recover VAT on costs linked to share sales. Now, not always can businesses recover VAT on such costs, but the case basically has pushed the boundaries even further to say that there are instances, particularly when the costs are linked with wider business activities, that you can recover VAT on costs. It is only a lower tribunal decision, so it's not binding on all taxpayers. But we are starting to have conversations with businesses, particularly those who have sold some parts of their business companies over the last 4 years, and looking at what have they done with share sale costs? Have they recovered any VAT? And if not, is there now an opportunity to do so? This was a very quick whistle stop VAT update on the kind of things we are seeing on VAT. Other than that, there's obviously the notification of uncertain tax treatments, but I know Mike's covered that, so I won't repeat that. I will now close off unless anybody had any questions. Okay, so just conscious of time, I'll hand over to Claire, but I am around if there are any further VAT questions. Thank you.
Good morning, everyone. It's great to be here and be able to talk to you this morning. I'm Claire Murray. I'm a director in our BDO's Global Employer Services team. My personal specialism is domestic employment taxes, but I work with a broader team who, between us, we advise on sort of expatriate tax matters, share plans, incentives, and also strategic reward advisory. So broadly anything pretty much that an employer may need in terms of advice around their employees. My first slide, thank you. And so this morning I've just picked 3 topics which which we're finding are very topical in the sort of financial services and insurance industry, but beyond. Actually, these are things which are cropping up for me and for my colleagues when we're just having conversations with clients. So the first thing I want to talk about is working from anywhere. And I'm sure it's not a surprise that COVID-19 has really changed the way employees work and from where they work. Obviously it was a dramatic change at the time, and but that has continued. So even whilst employees who are sort of traditionally office based can go back into offices in many cases, actually the working patterns that have now been introduced either across the whole workforce or on sort of employee by employee basis has changed quite a lot. And what that brings is sort of additional then considerations and challenges for employers in actually understanding, what additional things that they might need to provide to employees to enable them to work in a different way as they were in the office, but also what that means from a tax perspective, because, in the nicest possible way, broadly, whenever you give an employee something, probably there's going to be a taxable benefit implication in there somewhere, subject to some limited exemptions. So domestically, so within the UK, so where people are working remotely within the UK, there are potential expense and benefits implications, and there are obviously some temporary announcements as well as part of specific during the period of the pandemic. So things like provision of equipment to work from home. That's been in the legislation for a long time, but it's got some very specific and narrow requirements around how it works in practice. And there was a temporary easement, which continues into effect the 5th of April this year, so not very long to go now, where if reimbursed expenses might be exempt. And similarly, sort of home working costs, there was a temporary easement around that, where people were needing to work at home as a consequence of the pandemic. So, in broad terms, it's very hard for an employee to create their home as a permanent workplace for tax purposes, one for which they can claim costs of being at home, and there was that temporary easement. And actually, even with sort of flexible working policies, it's still probably quite hard in most cases for there to be a case for employees to have that home office to be entitled to be either claiming deductions for expenses themselves, or even actually travel costs into an office or other work location. And interesting, actually, I'd decided to talk about this topic, and on Friday HMRC have updated their internal guidance in the Employment Income Manual, if anyone wants to go and have a look at it, which covers this in a little bit more detail. So again, the rules haven't changed, but what they've done is try to kind of give some more practical examples. But because obviously I think the previous guidance was probably written well before technology was being used in the way it is at the moment. And the other things to think about in this are, the impact on existing benefits. I don't know if you have sort of cycle to work schemes, but a little detail that's often forgotten, but actually for the exemption to apply, the cycles are supposed to be used mainly for getting to work. That's actually a condition of the exemption. And actually, whilst there's no obligation actually employers to check, nevertheless that is an obligation. And HMRC did announce a temporary easement to that main purpose test during COVID, which applies up until April. But actually, from April, the normal rules apply. So if you do have staff that have bikes, or you're thinking about you're thinking of introducing it as a part of flexible benefits or sort of a benefits package, then it's just being really mindful of how your employees and where they're working, and actually will they be able to meet that main purpose test. So what this means is it's additional consideration. So actually, are you comfortable that you've been operating payroll correctly at the right time? But also, is there anything else that needs to be picked up as part of year-end reporting? So whether that's P11Ds or PAYE settlement agreements, depending on what the arrangements are and what's been agreed with employees, but just making sure that, I guess, there's additional checks perhaps as part of those processes to make sure that you are considering what needs to be reported. Just want to touch briefly on the international aspects of it as well. I'm going to go huge amounts of detail, but one of the things we are noticing that, for businesses which have been perhaps traditionally very UK based, suddenly they're discovering that people where they're flexibly working have been doing that from overseas, which in itself can bring a number of challenges, potentially legal, but from a tax perspective, understanding where someone may be liable to social taxes, equivalents of NIC. Is that overseas? As an employer in the UK, do you actually have any overseas payroll or withholding obligations? And obviously the rules will change very much depending on where in which jurisdictions people are based. but it's, I guess, thinking about what it is you want to do in this respect, and do you know what your policies are, and the extent to which you are prepared to bear additional cost of overseas jurisdictions, or if it's something that you just do not want to permit, and making sure that policies are implemented accordingly. And I think that goes the same, you know, across the UK. It's just being very clear about what you are and aren't prepared to do, making sure you understand the consequences of that, and then anything that does need reporting is being picked up at the right time. If you move on to the next slide, please. There's also a brief about the health and social care levy. Obviously, it was a slight tweak around NIC in the spring statement, but this in itself was announced back in September. Don't want to sort of go into huge amounts of detail, and I'm sure by now you're all fairly familiar with what's about to happen. But obviously, from this April, there's going to be an increase of 1.25% in the rate of Class 1 NIC for employers and employees, for a combined rate of 2.5%. And then from an employer perspective, that then increases the rate of Class 1A and Class 1B national insurance as well. And for anybody that's above statutory, the state drawing a state pension but it's still working, actually it doesn't affect them as of this April, but that will change from April 2023. And obviously in the spring statement there was an announcement about the increase in the primary NIC threshold, so from July. So that's what, you know, the government's announcement around that sort of, you know, there was sort of speculation whether the health and social care levy would be sort of paused in view of sort of current situation. So instead, I think what they've done is increase that primary threshold, so it doesn't help employers, but it will take a number of employees out of and paying national insurance altogether. And I think the statistic is something like 70% of employees will pay less and no more than NIC than they would have done previously. And then from April 2023, is this a formal health and social care levy will be introduced. So the national insurance rates will return to their to current levels. And the levy will apply broadly in the same way as sort of NIC does at the moment. So where there's reduced rates for certain groups of employees, or where there's an entitlement to claim the employment allowance, that will continue. I think one of the key things to note is that if you have any staff that are currently above statutory retirement age, actually they will be you will be liable to pay it for them, and they themselves will be liable to pay the levy. And again, it will continue to be liable on benefits which are reported on P11Ds or in the PSA. And you know, I think this will lead to some practical considerations around, you know, ensuring your payroll systems are fit for purpose. And I'm sure your people you work with in terms of payroll will be sort of already dealing with this. But obviously the increase in primary threshold adds yet another change kind of at the mid-year point in terms of ensuring that gets put through. So sort of several changes in relatively quick succession. And you know, it obviously does represent a cost to both employees and employers. So obviously, you know, many businesses considering about mitigation. So things like salary exchange, there's typically very few benefits now because the optional remuneration arrangement rules, where actually there's a real benefit in that, but things like pension, salary sacrifice, low emission vehicles, cycle to work, they're things which could still benefit from it. But you know, equally there is a consideration whether you would want to do that. Martin's already touched on ESG, and therefore actually is this something that you feel is appropriate to do? I mean, obviously if you want to introduce things as part of a wide remuneration package, that might be one thing, but doing it more overtly to mitigate costs is kind of considering where that fits in terms of, you know, your tax agenda and within your organizations. Next slide, please. Thank you. And then finally, I feel like off-payroll labour has probably been talked about to ad infinitum over the last few years ahead of the introduction of sort of change in rules in the private sector for medium and large businesses from last April, so from the 6th of April 2021. But I just thought it was worth, I don't want to go into the rules in any particular detail, but just, I guess, talking through what some of the things that have come out from conversations we've had with clients over this last year, which is even now I think there's some lack of understanding about how the rules apply. So not the sort of the rules aren't necessarily being implemented correctly, and a lot of employers are using CEST, the HMRC's tool, as a means of determining status. However, what our conversations are saying is they don't actually understand what some of the questions in CEST mean. So actually the HMRC have some quite narrow views in some cases, and obviously while CEST can be relied upon, if you're actually not interpreting the questions properly, then that obviously leaves you open to challenge and risk. And at the moment, that over the last year, there's been a real, HMRC's focus has been very much on education. So there has been some focus on certain sectors, financial services being one of them, but that has been more of a sort of within sort of an educational bent, whereas we're expecting any sort of future correspondence to be more around compliance and ensuring businesses are being compliant. So I think the sort of takeaway at the moment at the end of year one is just to revisit and what got put in last year in April. Are you still comfortable it's doing what it should do? Do the right people have the knowledge? And actually, if you concluded that you were medium or large, or actually weren't within the regime, just making sure you continue to keep that under review. Conscious of time, so I've just sort of gone through that relatively quickly. It's the end of the sort of employment tax section and end of the tax section generally. So I'm going to hand over to the regulatory update.
Brill, thank you, and great to be here today. So yeah, we're now moving to the second and final part of the session, so the regulatory update. So I'm afraid I can't promise the subject area getting any lighter, but hopefully relevant and interesting. So by way of introduction, so my name's Nicola Ball. I'm a director in BDO's Financial Services Advisory team with a focus on the insurance sector. And in that role, I sit within our compliance and regulatory conduct team. So I work on a range of projects supporting clients sort of navigate through regulatory change. I also deliver skilled person reviews for the PRA and FCA. And I've got Matt Smith also joining me today, and Matt's a manager in our team. And actually he's relatively recently joined from the FCA, so sort of bringing some of that knowledge to this session too. And during this part of the session, so we're going to look at some of the key areas of regulatory focus for financial mutuals. So exploring a few topics in a little bit more detail too. So those being operational resilience, the consumer duty of care, as well as diversity and inclusion and culture to some extent too. So I guess just to sort of set it up. So, regulation and its application is relevant right across organisations, with new regulations requiring both sort of strategic and technical consideration, with opportunity to approach requirements sort of positively and to the benefit from, allow you to benefit from those intended outcomes, as well as being able to respond to what we're seeing, sort of some more deeper and more far-reaching questions from regulators to firms and management. And a lot of these topics in the spotlight also raise questions around a firm's core purpose and values. So it's really important to sort of take the opportunity to think about the requirements within the context of a firm's broader strategy and its risk appetite, and not sort of just approaching from a sort of tick box exercise. So yeah, moving on to sort of this overview slide. So we've provided a bit of a snapshot of some of the key regulatory priorities which are relevant to financial mutuals. This list on the left-hand side is particularly drawn from the regulators' cross-sector priorities from their business plans, particularly the FCA's, and on the right-hand side, we have drawn these from other regulatory communications and publications, such as portfolio letters, supervisory strategies, and also themes that we're seeing from skilled person reviews. So yeah, apologies, you might find it is a bit of a whistle-stop tour, this slide, but we do spend a little bit more time on those areas highlighted after, and we'll have time for questions at the end, or equally we're happy to pick up on any areas after the session too. So I'm going to skip over diversity and inclusion because we're going to come on to that. Sorry, back to the previous slide. I am going to talk through some of these, Rima. But yeah, so fraud strategy, actually, in terms of what this is about, this is about setting a clear ambition to drive down external fraud across all sectors, sort of recognising it requires a collective effort drawing a focus to firms' own controls and oversight arrangements in this space. So, you know, that will be kind of within the, you know, the spotlight from the regulator. Financial resilience and resolution. So we're sort of seeing more of, you know, this being in the spotlight, you know, linked to operational resilience and a number of these topics. But this is really, you know, looking at that, you know, when firms fail and ensuring that if they do so in an orderly way with the expectation that firms plan for it and they plan for it so that they avoid poor customer outcomes or disruption to the market. So, you know, hoping it doesn't happen, but if it does, that there's been some thinking around it. Environmental, social and governance. So, you know, we've touched upon ESG, you know, it's a big topic, but really, you know, recognising the importance of financial services and markets in the UK's transition to low carbon economy and the, you know, government's commitment to achieving a net zero economy. So this is looking at firms and requiring them to respond to a number of sort of proposed changes to the regulatory framework in relation to disclosure rules and, you know, other things such as climate change risk, etc. So, you know, very much a focus and a big topic that will continue to remain in the spotlight. Operational resilience, I'll come on to kind of mention international priorities here. This is really a focus around, you know, that the regulator has to make sure that they've got international cooperation and partnerships with other supervisors and global standard setting bodies to ensure that firms can't avoid regulations by sort of taking advantage of a different country's rules. So they sort of, you know, they keep that up on their agenda. On the right hand side, so culture and consumer duty of care will come on to, but just some other topics that, you know, we're still sort of seeing come up in themes, as I say, in a number of communications from the regulators. But vulnerable customers, so following an FCA paper published in 2021 on guidance for firms on the fair treatment of vulnerable customers, the regulator's really looking to see how firms are putting this into practice within the customer life cycle and how they are making adjustments for different types of vulnerability, you know, looking across sort of financial, life events, health, capability, etc. So really sort of seeing how that's coming into practice. Value of products. So this focuses on the risk that, you know, consumers may purchase products which don't provide fair value or don't meet their needs. And this is cutting across, you know, distribution strategies, including remuneration arrangement. It cuts across the new pricing practices and GI value measures requirements, as well as, you know, proposed consumer duty. So firms really need to be able to, you know, have the data to be able to identify where customers may not be receiving fair value, but equally to demonstrate an evidence that indicates that they are. Third-party risk management. So, you know, third-party failure consistently ranks towards the top of, you know, the main causes for operational disruption, and that's against a backdrop of high customer and regulatory expectation. So this, you know, all drives a focus on robust third-party risk management. And there's a number of related topics, you know, one of which operational resilience, which we'll come on to, but also the sort of current appointed representative consultation, which references how there's often a lack of adequate due diligence before appointing an AR, poor ongoing control and oversight. So there's you know, now a real sort of clear expectation that firms need to have robust, proportionate, risk-based frameworks for their third parties that cuts across the supply life cycle from, you know, take on right through to offboarding. And then sort of finally on this slide, effective governance. So this in particular is a common thread that we see in a number of skilled person reviews, so particularly where things have gone wrong, both from understanding where there has been a breakdown in governance and reporting, as well as accountability being driven through SMCR. So, you know, more important than ever to have a sound, you know, basis for a firm's governance and board structure, related processes and reporting and clarity of roles, so you can evidence decision making and, you know, reasonable steps taken by the firm as you go through sort of the course of business. So now I will move on to the next slide. So we're going to touch on operational resilience. So operational resilience is one of those, it's a cross-sector priority for both the FCA and PRA. You know, recognising that a lack of resilience represents a threat to both financial stability, viability of firms, markets, but also can cause harm to consumers and other market participants. And sort of where we are with operational resilience at the minute. So following FCA and PRA discussion papers, consultation papers and final papers, new requirements are coming into force at the end of this month, which really drive a focus on ensuring firms consider how disruption to their business services can impact beyond their commercial interests, making sure that they're setting tolerances for disruptions, ensuring continuity of service, and also sort of mapping and testing important business services to identify vulnerabilities and sort of addressing where those are. And I think, you know, the FCA has observed that the financial service industry actually responded quite well to COVID-19, but I think, you know, have really recognised that that's tested one scenario. So, you know, can't, you know, I guess take comfort in that quite cautiously, and also recognising that, you know, this is a sort of shift and a move away from business continuity. It really requires firms to recognise that things will go wrong and accept disruption, but, you know, make sure you prepare for it and that it doesn't impact their services excessively. So if I move on to the next slide, so I guess, you know, coming back to the requirements and the regulations that have come into force. So in terms of who's in scope, so anyone who's dual regulated, also enhanced scope senior managers and certification regime firms, as well as entities authorised or registered under the payment services or electronic money regulations. And in terms of the requirements, so this slide sort of sets out a bit of an overview, and I'll sort of talk about what needs to be done by when. So the final rules were published on the 29th of March 2021, so just over a year ago, and that gave firms a year to implement the requirements. And so what should have been done by now or by Thursday this week? So for those firms that are in scope, they should have, you know, really operationalised their operational resilience framework, and they should have identified important business services, defined impact tolerances, carried out resource mapping of those important business services, carried out an appropriate level of scenario testing so that they can identify vulnerabilities and lessons learned, developed a comms plan, developed a sort of framework and policy to sit around that. And all that should have been articulated with supporting justification and rationale in a self-assessment document, which should have been approved by the board and which the regulator may request. From the end of March to the end of March 2025, there is a 3-year transition period, and that has a sort of a number of, you know, asks of firms. So firstly, you've got that period to make sure that the firm can actually remain within the impact tolerances that they've set for each important business service. So that means that you should have ensured that any gaps identified in the initial phase are closed, lessons learned are addressed, but also that you should continue to map resources and test scenarios to the fullest extent of sophistication. And I guess the other, you know, related piece is really making sure that the approach and framework does become operational and, you know, built in within the governance framework. So, you know, for example, ensuring the committee governance and MI is working, ensuring implications and links with other areas such as operational risk appetite, you know, all that's made clear, as well as sort of keeping the self-assessment up to date and making sure it's regularly reviewed by board in line with the requirements. I think just in terms of, I guess, sort of key takeaways as we move into that transition period. So I think for those firms which are dual regulated, there's, you know, although there's kind of 2 sets of requirements that you're looking at, and although those requirements are quite, you know, are similar in many ways, there are some nuances, which means, you know, for example, each element requires 2 lenses. That might be in relation to, you know, 2 sets of impact tolerances and, you know, 2 sets of rationale in terms of your important business services, for example. So I think it is really important to kind of make sure you keep that lens as you sort of move through the transition period and operationalise operational resilience. I think the sort of second piece is, you know, really using this period to ensure that you have an appropriate level of understanding of third parties, that you're using it as a chance to challenge the appropriateness of any relationships, you know, particularly where a third party may present you with a challenge in terms of meeting some of the requirements, for example, sort of staying within those impact tolerances. And also that, you know, I guess just to highlight that I think we will see further clarity about good and bad practice from the regulators as we move into this period. So, you know, particularly as the regulators start to see self-assessments, they see, you know, start to see how firms have really sort of brought this to life. You know, I think we recognise that there is some flexibility in the requirements. So, you know, in terms of, you know, what is good and bad practice, that's not perhaps been as clear. So I guess just to make sure that as your firms move through that programme, that you build in a mechanism just to make sure you're taking into account any learnings from the industry or from the regulators as you go. And I think finally, I guess it's really just a sort of, you know, suggestion that to make sure that you really challenge the business, that all the work and effort that's gone into operational resilience is driving helpful and meaningful conversations in the business, and, you know, to make sure that it hasn't just been done to sort of, you know, answer a request from the regulator, but it does sort of become a living and breathing piece. So if it's not, to really sort of, you know, question as to why it's not. Matt's gonna pick up on consumer duty of care quickly, so I will pass over to him and we'll move on to the next slide.
Everyone, thank you. Thanks, Nicola. As Nicola introduced, my name's Matt Smith. I work as a manager in the Financial Services Advisory team at BDO. Having spent a dozen or so years at the regulator, the FCA, it sort of puts me in quite a good position to see some of these rules being put into place, some of the changes being applied to industry, and seeing also some of the challenges that firms have had in implementing them. I wanted to talk a little bit about the new consumer duty of care, which I think for those of you who will be seeing, there's been a couple of consultations that have run the course. One closed recently on the 15th of February, I think, with the final rules set to be published at the end of July and implementation next year. I think one of the things to highlight with this is that time tends to disappear quite quickly, and as you'll have seen with the operational resilience piece that Nicola's been talking about, all of a sudden it's there and it's upon us. And I suppose this is just a bit of a call to start considering these things and to start having a think about what it means for you and your firm and where you are in this process. In terms of the specific changes and what's actually happened, well, the consumer duty seems to and looks to build upon a lot of the increased focus that the regulators had over the last few years, and what you've seen with different changes to rules and regulations upon improving customer outcomes. Specifically, if you have a look, it's building on some of the changes to SMCR with culture, and having a look at how firms can personally take that accountability of ensuring sort of better outcomes for customers in a way that perhaps we haven't had to consider previously. So I think one of the things to be really sort of mindful of this is that it's a bit of a step change upon where we have been before and to where we need to get to and where they're looking to get to, by calling out some specific rules and a specific power about this piece. I think underpinning the consumer duty are three key elements. Firstly, there's a consumer principle which sets out some clear language and that should reflect the overall standards that the regulators are expecting of firms. They're looking that a firm must act to deliver good outcomes for retail clients, which sort of gives you the scope as well. So considering retail clients, I think they've also considered acting in the best interests of retail clients. And for those of us that are a little bit more in the general insurance space, we recognise similarities between that and IDD. And I think that a key thing is it's sort of strengthening the expectations around Prin 6, Principle 6, which it will look to build upon and ultimately may either build upon or replace depending on the sector that you're in. There's three specific cross-cutting rules that everyone will need to consider. Firms must avoid causing foreseeable harm. I think some of the challenges that we've seen when we've engaged with firms is, well, how do you do that? What is foreseeable harm? What's the line? What's a proportionate amount to spend looking at foreseeable harm, and how could I justify that? How do I identify it? How do I pull that out from the engagement with customers? another piece was enabling customers to pursue their financial objectives. Well, what is the customer's financial objective? How much of that, as firms had to do before, how much of that have we had to consider? And acting in good faith towards customers. Well, I mean, that seems pretty straightforward and pretty standard, but I think when you sort of put this in combination with the other rules and regulations around product governance and product design, how do you make sure that it does what it should do and ultimately ends up in the market that it's meant to end up in and supporting the customers that it was designed for? There's 4 outcomes which they're looking to test upon and looking to make sure that is in play. Firstly, it's making sure that customers understand what is, or get enough information, the communications, and that enable customers to understand and make informed decisions about products and services. So having to think a little bit about the demographic of the customer. Is this everything that they need? Do they understand? Do they know what they don't know, perhaps sometimes? So having a little bit of consideration in that space. Looking at the design of products and services, making sure that they end up where they're designed for, making sure that there's been sort of adequate testing if it's a particularly high risk product. Does it end up with those that have the right appetite? Another piece was around customer service, so making sure there's enough service and support to meet the needs of customers. The elements of a business, is there enough consideration on areas of the business which perhaps that are more supportive? I think traditionally there has been a mismatch in resource that has passed to the sales teams and the sales and the upfront piece, but does that customer service side and does the support functions have the adequate resources in place to be able to support customers and their needs and meet up with their expectations? And finally, making sure that the products and services are fair and fair value. For those of us in insurance and insurance background, you have seen the fair value pilot and been occurring at the FCA for a long time, and ultimately that's come into play. But just considering what fair value looks like, how would you as an organization demonstrate that it is a reasonable cost to product ratio, cost to product benefit for that customer? As I have mentioned before, and we've talked about some of the pieces here, the key date is next year, 30th of April. So start having to think about that and about what it is that you need to do and where you are in that journey and how much of that you need to do. Different sectors, different organizations need to take proportionate approaches to make sure that it is the right outcomes, or that they're focusing on the right outcomes for their customers. If we can move on, please, to diversity and inclusion. Again, another little bit of a whistle-stop tour. We wanted to call this out because I think diversity and inclusion is not a subject that needs a lot of introduction to many of us. We've seen it being mentioned for a while. But I think what is crucial is this year at the FCA, it is getting its own specific call out and specific category, whereas before it's kind of been bumped and bundled together with sort of culture pieces. Well, it's now actually being called out in itself as a standalone topic. So it's worthwhile firms and organisations considering their performance of their duties and obligations under the D&I piece. The last consultation paper was in July last year. I think we're expecting another consultation paper summer this year, either Q2, Q3. And it's worth just noting around some of the benefits around this and perhaps how it's linked to some of the things that we've spoken about already, about the benefits such as, by having an appropriate and diverse workforce, how can that help you make sure that your products are actually being designed by the core value or core customers or people with similar demographics that those would be using them? How can it help you access new markets? Does it improve the company's reputation? I think there's also a lot around racial and ethnic targets and making sure that gender pay gaps and things are all considered there. Some of the other things that perhaps often overlooked when we touch on diversity and inclusion is social status, and how is having a mixed workforce, and particularly a mixed senior leadership team, how does that help you to be a better organization and consider the needs of your customers and clientele? So really it's very, very quick whistle stop tour on that subject, but we just wanted to remind everyone of the kind of things that you need to consider and have a think about.
Perfect. And just final slide. So before we kind of move on to questions, I do want to leave time for that. Is there a previous slide on? Oh, okay, I think it might be hidden. We were, I guess, just linked to diversity and inclusion, picking up on culture, which continue to appear in supervisory strategies, portfolio letters, referenced in skilled person requirement notices. Recognising a few years ago the FCA introduced 4 cultural levers, so purpose, leadership, governance, and people, which touched on recruitment and reward. In recent communications, we're seeing a lot of focus on purpose in particular, saying that the FCA will be assessing how effective a firm's purpose is at reducing harm from their business model. So this would include examining firms' stated purpose, how they influence strategy, and how they're committed to communicating and operationalising through the organisation that sort of purpose and culture. So there's a view that, if you have a purposeful firm with an inclusive agenda and safe culture, that should drive better outcomes. So yeah, I guess just linked into that piece. So highlighted, culture, just because it does still remain a sort of common golden thread through the regulator's work. Anyway, so I will, I think we have got time, a little bit of time for some questions, so I will hand back to Martin, I think, just to sort of steer us through that last piece.
Thank you very much. There was another Martin there, so I'm hoping you were expecting.
Yeah, I wasn't. Yeah, you're the right person. There you go.
Very good. Well, we've covered an awful lot of ground in the last 80 minutes, and so there is a chance, if you have a question, to drop one down at the bottom of the page. If you unveil the question box, you will find those. Got a question here already about responsible tax. So that, I think, would go to Martin, and I think that's a topic which I guess we haven't really explored so far. Smaller mutuals typically, for instance, are not required to produce and publish a tax strategy. So I think that the question here is around practicality. What does a responsible tax approach look like to a mutual? We pay all of our taxes that are due in the UK, and we only employ people in the UK. So to what extent can we confidently describe ourselves as being very responsible in the way that we take forward our tax approach?
Yeah, and I think that's a good question, because I realise that as part of the presentation, I was talking about looking at global total tax contribution and so on, which isn't going to be relevant. Clearly, isn't going to be relevant to all businesses. I think it's breaking it down into there were three aspects to a responsible tax approach, which I think, to be honest, apply across all businesses. And the first one is, regardless of the size and nature of a business, then there is an approach to tax, a tax strategy, which is still important for those within the business. And it's setting up those clear tax principles for the organisation, so low risk appetite and so on. It's looking at the types of ensuring that any form of broader tax planning or products or whatever, that there's a good commercial reason behind everything that's done by the business, not just at a corporate level, but also looking at things like, I guess the use of off payroll labour, for example, and just ensuring the business is taking a principled approach to that. But then importantly, it's ensuring that those principles are embedded more broadly within the organisation. This is where we talk about having the control framework. It's about, if the organisation does have these tax principles, and making sure that the conversation about those principles extend to others within the organisation who maybe have a concern about sustainability and the other important matters that we've been discussing, ensuring that those principles are embedded within the organisation, that the business's overall approach to risk is communicated within the organisation, making sure that any relevant policy and procedure documentation that exists within the organisation, ensuring it's documented and ensuring it takes this responsible tax approach into account.
Great, thank you for that. And I guess it's something that we'll all be thinking about more as time goes by. Equally, there's a question here for Claire about working from home arrangements. And the more that people are now undertaking hybrid working, are there any particular tax consequences or risks that a firm should be aware of in terms of the way that it takes forward hybrid working, and what proportion of time is a good one from a tax perspective to employ home working?
Okay, yeah, there's certainly very, very topical. In terms of the time at home, I mean, I suppose with friends we're talking to achieve tax ends or more generally. I mean, I think there's a broader, probably cultural piece, about how much time you want somebody to be in the office and or visible, and the interaction with staff. And so I think it will very much depend probably on someone's role, the business itself, and actually what how they can best do their particular role. And so it may be it's something that's likely to vary between businesses, but also even at perhaps different grades or roles within organizations. And I think that's probably, to me, is that it's more important to drive a policy from what is operationally important, and then pick up the tax consequences which fall out of that, I suppose. So it's thinking, what is it you want to achieve, rather than let tax drive the sort of the way businesses moves forward in that respect. And in terms of the tax itself, I think it's being clear that just because someone works at home quite regularly, even if it's under relatively formal policy, that's probably unlikely to make home their permanent workplace from a tax perspective. So things like traveling to that office that they would otherwise have been going to on a regular basis is still likely to be commuting. So there are, HMRC have very specific views on this, and they have just released some more guidance. But broadly, where there's a choice, even if it's a limited choice, unlikely that home will be a sort of a proper place for tax purposes. But there is the more limited test, which is for employee home working costs, which are provided by the employer. So that and I think more commonly it's the £6 a week, £26 a month, where there has to be some formality to arrangement, but those costs can be paid by an employer tax free, without there having to be a sort of home, a proper workplace for tax purposes. But the key is that the employer is paying them, and that's been one of the things that was tweaked during the pandemic, where the employee could claim some tax relief without the employer paying anything. So I hope that helps. Anything else you want me to cover? I don't know if anyone to expand on the question.
I think if there's anything else you can point us to, we can happily, for instance, if there's any papers that BDO have covered on that, we'll happily cover those around when we circulate the slides afterwards. It's obviously a big topic to cover in 60 seconds, so well done on the quick summary, Claire.
Okay.
We've got a couple of questions on regulation, which I'll finish with, and ask maybe Nicola and Matt to prepare to answer these between themselves. First one is around the consumer duty, and question is whether to what extent the FCA can confidently avoid retrospectivity in the way that it applies the consumer duty. And then the second one, and it's definitely not linked, is there any sign of the long-promised simplified regulatory regime for small insurance and bank organisations? It was supposed to be a potential Brexit benefit.
So I think on the consumer duty one, I think it's a very relevant question, because I think firms are seeing it being referenced already in some of the communications. It's certainly, I think, been part of the feedback going back to them. So I think it'll be interesting to see how they respond to sort of some of that feedback, and whether they sort of do understand that difference. So I think, you know, some of that to be seen, and, you know, also recognizing the fact that there's other sort of regulations that are also cutting across this place in terms of pricing practices and value measures, etc. So I think, yeah, there's certainly the ask that, you know, the regulator looks at this holistically, and doesn't try to do that. Matt, is there anything else you want to add on that piece? I know we're short on time.
No, not on that piece.
Yeah, and then again, I guess on the second one, I think my view is that you know, again, it's a very common challenge. I understand the question, because we do see it quite a lot, and again, it goes down in the feedback papers. I think the regulator, you know, they often, you know, refer to all regulations being pragmatic and proportionate, because, you know, actually they will align to your business strategy, and for those kind of less complex firms, it should, you know, you should have that ability to be proportionate. And sometimes you see them trying to sort of play that through the sort of SMCR regime, so, you know, a different requirement for core firms versus enhanced, but you know, still challenged in terms of that space. Matt, did you want to pick up something on that one?
Yeah, and so I get the question. I think the short answer is to the have we seen anything? No, we haven't. But you know, to build on what Nicola said, yeah, they would argue about proportionality being in place already. I think the key thing here is if it's been set as a key objective for the FCA to deliver upon as yet. And I think that might be a more interesting question to find out from the FCA directly, so if it's been instilled with them as something that they need to take forward, or, you know, and have they started thinking about it as yet, which, you know, we don't know the answer to.
Great, thanks for that. And of course, there has been a consultation on a strong and simple framework for banking. We did respond to that and say, let's have one for insurance as well. So we're still waiting for that one, but as you say, proportionality is very key, and the review of Solvency II is a core opportunity to seek for more proportionality there. So we'll be looking at that closely. We've run out of time. We've had a wide range of speakers talking through an awful lot of topics, and I hope you've found many of them to be useful. They're, by their nature, not every topic will have been valuable to everybody to the same extent. But as a layperson on tax, it was great to see such wide coverage in a short space of time. For those looking for a more in-depth review of tax and the implications for our sector, don't forget our tax training day, which will be happening as an in-person event this year in London on the 7th of June. Hopefully you can join us for that, and keep looking out for the bulletins from Tamsin telling you about the regular events we have on regulation and many of the other topics that have been covered today. So finally, from me, thank you to everyone who's attended today. I hope you found that useful. Look out for a note through from Tamsin just with a copy of what we've covered. And thank you in particular to Thomas and all of the team from BDO for joining us today. It's much appreciated, and I think it was a great subject. So thank you to everyone. Enjoy the rest of your day, and we'll hopefully see you soon. Bye for now.
Thank you, Martin. Thanks. Bye.